Welcome to the Deep Dive. Today we're digging into CME Group's Q3 2025 results and their strategic moves.
Yeah, we're unpacking the financials and figuring out their big bets for the future. Let's jump right in. Hashtag earnings results and market reaction.
Okay, so the top line numbers, a bit of a classic split decision, right?
Exactly. Adjusted EPS, the earnings per share, that landed at $2.68.
Which was slightly better than expected, beat the forecast of $2.64. So a positive surprise there, about what, 1.5%?
That's right. That was the good part. But the flip side was revenue.
Yeah. That came in at $1.5 billion.
Fell short of the $1.53 billion forecast. So a miss of just under 2%. And you've got to remember, this was compared to Q3 last year.
Which they called extraordinarily strong, didn't they? So a tough
A
comparison.
very tough comp, yeah. Revenue was down 3% year over year because of that.
Okay, so revenue slightly down, EPS slightly up. How did the market take it initially?
A bit cautious. The stock dipped, I think it was 1.6% pre-market.
Right. Wall Street often reacts more strongly to that top-line revenue number first, doesn't it?
It does, yeah. Sometimes overshadows a decent earnings beat, even with good cost control, which we'll get to.
But taking that crazy strong 2024 quarter out of the picture for a sec, how did Q3 2025 actually stack up historically for CME?
Well, that's the kicker. The actual profit numbers, they were phenomenal.
Really?
Yeah, the adjusted net income was $978 million, and that $2.68 EPS, it was actually the third highest quarterly result they've ever had. Ever.
Wow. Okay, so definitely not a sign of weakness then.
Not at all. It shows real underlying strength. And, if you look year to date for 2025, their adjusted EPS is actually up 9% compared to the record year of 2024.
So the overall picture is pretty robust. Hashtag tag 2, operational strength and revenue drivers.
Absolutely. And that strength comes from activity, from people actually using the markets.
Right, it's not just cost cutting. What did the volumes look like? How much trading was happening?
Well, the average daily volume, the ADV, hit 25.3 million contracts. Again, slightly down from that record Q3 24, but still.
Still huge.
Yeah, their second highest third quarter ADV ever. Shows consistent use.
And what about open interest? The number of contracts left open at the end of the quarter. Does that tell us anything?
It does. It tells us about commitment, about ongoing risk management. OIR was 126 million contracts end of September.
And that's significant because
It's at the highest level they've seen at the end of September in 5 years. So customers are definitely holding positions, managing risk long term. They saw records in large holders across rates, equities, and crypto.
Okay, let's talk crypto. You mentioned it there. The growth sounds pretty wild.
Oh, it's staggering. Simple as that. Crypto ADV hit a record 340,000 contracts a day in Q3.
340,000 per day.
Per day. And get this. That's an increase of over 225% compared to last year.
Wow. 225%. Is that just Bitcoin and Ether driving that?
Mostly, but not entirely. They mentioned the new Solana and XRP futures launched earlier this year are already contributing. Shows diversification within that crypto space is working.
Interesting. And it wasn't just trading fees making money, right? Market data did well, too.
It did. Record quarter for market data revenue. $203 million. First time they've crossed the $200 million mark.
Okay, and what's driving that? Just more people signing up?
Pretty much. Growing subscriber count, plus some price increases they implemented. It's up 14% year over year. Shows the value people place on their data feeds.
Let's touch on the rate per contract, the RPC. That went up a bit, too, to 70.2 cents from 69 cents. Why the increase?
That's mainly about the mix of products being traded.
How so?
Well, basically, there was a lower proportion of the really small, cheap contracts being traded, the micro equity index futures.
The ones more popular with retail traders, maybe.
Exactly. So with fewer of those low RPC contracts in the mix relative to the bigger, higher-priced institutional contracts, the overall average price per contract naturally drifts up.
Got it. So it suggests stronger activity in the higher value institutional products.
Precisely. Hashtag 3, financial guidance and capital efficiency.
Okay, so strong profits, strong underlying volumes. Now, let's look ahead. What about their spending? Did they update their expense guidance?
They did, and it signals some serious discipline. They call it focusing on efficiencies.
Right.
They now expect total adjusted operating expenses for the full year 2025, not counting license fees, to be around $1.625 billion.
Which sounds like a lot, but how does that compare to what they thought before?
Well, that's the key. It's $10 million lower than the guidance they gave just last quarter.
Yeah.
And it's actually $25 million below what they originally expected at the start of the year.
So they're actively finding ways to save money throughout the year. That's pretty good management.
It really is. And that cost control, combined with the revenue performance, led to a very healthy adjusted operating margin of 68.4% for the quarter.
Almost 70 cents a profit for every dollar of revenue. Impressive.
Very efficient. And speaking of money, their balance sheet looks solid too. Ended the quarter with about $2.6 billion in cash.
Plus, they got that big windfall coming from the OST-TRA sale, right? The joint venture they sold with S&P Global.
Exactly. That sale was valued at $3.1 billion enterprise value. CME's share of the net proceeds should be around $1.55 billion.
Huge chunk of change. Any word on what they'll do with it?
Yeah.
Buybacks, dividends.
The board's reviewing it now. Could be buybacks, dividends, maybe strategic investments. But it highlights their capital position. Remember, they've returned over $29.5 billion to shareholders through dividends just since 2012.
Wow. So they have a strong history of returning cash, and now they have even more firepower.
Definitely. A fortress balance sheet, as they say. Hashtag tag for strategic innovation and future expansion.
Okay, let's shift to the really future-focused stuff, the big strategic plays. The CEO summed it up as distribution and efficiencies, right?
Yeah, that seemed to be the theme. And the biggest headline grabber, the most surprising one for me, was FanDuel.
Right. Teaming up with a sports betting giant. What's the plan there?
It's a major push into the retail consumer space. They're partnering with FanDuel to create and distribute these new event-based contracts.
And these are super simple, right?
Yeah.
Like yes/no bets on market moves.
Exactly. Fully funded, meaning you put up the cash up front, simple yes or no outcomes, and you can get involved for as little as $1.
$1. Wow. What kind of things can people bet on?
Well, it's benchmarks like the S&P 500, NASDAQ 100, also commodity prices, oil, gas, gold, even crypto, and economic numbers like GDP or CPI.
So financial and economic events, but packaged like a simple bet.
Pretty much. And the strategy is pure distribution. FanDuel has, 13 million potential accounts. It gives CME direct access to a massive retail audience for these simplified products.
A very different direction for them.
Interesting. Okay, another big move, 247, trading for crypto.
Yeah, they announced plans to offer 247 trading for their crypto futures and options, starting early 2026, assuming regulators okay it.
Moving beyond the traditional Monday-Friday trading week for crypto. Right, and the key enabler for this, the tech behind the scenes, is something they're working on with Google Cloud. Tokenizing cash.
Tokenizing cash. Explain that. Why is that needed for 2047 trading?
Well, think about it. If markets are trading all weekend, clearinghouses still need to manage risk. They need collateral, margin payments, right? But traditional banks are closed.
So you can't move dollars easily outside banking hours.
Exactly. Tokenizing cash means creating a digital version of that cash on a shared ledger system. It can move instantly, 247 between firms, outside the old banking rails.
So it allows for continuous collateral movement and risk management, even on a Sunday afternoon.
Precisely. It's the crucial plumbing needed to support a market that never sleeps.
Makes sense. So while they're building that future tech, they're also refining their core markets, like with BrokerTec Chicago. What's that about?
Right, that launched recently. It's about bringing the trading of actual cash U.S. Treasuries physically onto the same campus in Chicago, where their big futures and options markets trade.
So cash treasuries and treasury futures, side by side. Why does that physical proximity matter?
It's all about speed and efficiency for sophisticated traders who play the tiny price differences between the cash bond and the future. Since it launched in early October, they've already traded over $1 billion notional.
Okay, $1 billion. That's significant volume quickly.
It is, and here's the interesting stat. 66%, two-thirds of that volume, traded at price points that weren't even available on the main New York electronic market, the CLALO.
Really? So it's actually creating better, tighter pricing.
It seems so. That co-location is attracting unique liquidity that wants that hyper-efficient connection between cash and futures.
Fascinating. Okay, one more efficiency piece. Cross-margining with the DTCC. Sounds technical. What's the benefit for clients?
Yeah, it's definitely in the weeds, but it's a big deal for capital efficiency.
Yeah.
They're extending an agreement they have with the DTCC, specifically FICC's GSD, which clears government bonds, to include the end clients, not just the big clearing members. Essentially, it lets clients use the value of their treasury bond positions to offset the margin they need to post for their interest rate futures positions at CME.
So if you hold treasuries one way and futures the other way, they recognize the risks partly cancel out.
Exactly. So instead of posting full margin for both positions separately, the clearinghouse looks at the combined portfolio risk.
Which means clients need to tie up less capital overall as margin.
Precisely. frees up potentially significant amounts of capital for them to use elsewhere. It's a major win for efficiency across the financial system. Hashtag tag tag outro.
So when you pull it all together, it really feels like two parallel tracks driving CME.
Yeah, I think so too.
On one hand, you've got this relentless focus on cost discipline, squeezing out efficiency, boosting margins like the expense cuts and the cross-margining.
Right, shoring up that incredibly profitable core business.
And on the other hand, really aggressive innovation,
Mm.
pushing into new assets within crypto like Solana and XRP, and then this huge leap into retail with FanDuel.
It's quite the balancing act, isn't it? They're using the strength and stability of their traditional regulated institutional markets, the broker tech integration, the margin efficiencies to basically fund these ventures into newer, maybe less certain frontier markets.
Like the 2047 crypto trading and the consumer event contracts.
Exactly. Defend and optimize the core while taking calculated bets on the future. It seems smart.
And that 247 piece feels like a potential game changer.
Well, the CEO himself said something like 2047 is coming across the world whether we like it or not.
Right.
So CME is clearly trying to lead that charge, starting with crypto where it makes the most sense initially. And they're building the tech, the tokenized cash infrastructure to make it work properly.
Which leads to a final thought, maybe for you listening.
Yeah, if this 24/7 model proves successful and efficient in the crypto world, how long before that pressure, that expectation for continuous trading starts bleeding over into other massive traditional asset classes? Think about interest rates or equity indices. Could we see a push for those markets to eventually go 24/7 too? The demand for constant liquidity isn't going away.